Welcome to How to Prepare for an IPO. I imagine some of you are thinking about your company going public, or maybe it's already gone public, or you just got a new job at a company that issues equity compensation and people are talking about IPOs. So this quote, that was a relatively simple and stress-free process. Said no one ever about an IPO. John and I both have taken our clients through many IPOs. We have been there on the front lines in the trenches with our clients at private companies that flip to public, and it's fun. It's a lot of fun. Maybe you're going down to to Wall Street. Maybe you're ringing the bell with your colleagues. You're getting drunk at the Irish pubs down there all day. It's super fun, but it is a complex transaction that has many different parties. So we are here to basically walk you through what's going to happen, things to look out for, and how to plan for it, so you can make sure that you get the most wealth out of this as possible and pay as little tax as possible. So next slide, please, Mr. Owens.
Oh, all right, wrong way. There we go. There we go.
Let's go forward, not backwards.
There we go. Yeah, we're moving forward here.
IP rodeo. All right, so here's our IPO timeline. So on the left, we're waiting forever for a liquidity event, right? You get hired. There's talks in the Slack channels. Maybe your CEO or your CFO is saying, we're going to go public next year. Last year, we were blaming that we didn't have a president. We didn't know the outcome of the election. So that was why there was uncertainty in the IPO markets. Now we have an uncertain political climate. So that's why there's uncertainty in the IPO market. So we don't know when your company's going to go public. And really the optimal time to get advice around an exercise and sale plan of your stock options, if you have those, is probably 4 to 5 years before the IPO. Now, I realize that's hard to do because you don't know if your company is ever going to IPO or have any kind of liquidity event. But John and I have seen some incredible, stellar $20 million, $30 million, even more than that exits when we do planning at founding of the company or shortly thereafter if you're an early employee. So, you kind of have to play your cards right. And obviously the market and your company has to play their cards right for this to happen. But the earlier we can get to you, the earlier we can do tax planning and some strategy, the better. So then, we're waiting, and then it kind of happens really quickly, right? We're waiting. We could be waiting for years or decades in some cases. And typically your IPO gets announced, maybe internally, you start to hear whispers. If you're high up, you are probably involved in the IPO planning. And then the kind of official flag in the sand to say, hey, we're ready to go. A document called an S1 is filed. S1s, once they're filed, can also be withdrawn. We've seen that a lot recently where an S1 gets filed, company says, we are ready to go public. And they go, just kidding, don't like the market, or we're not ready, didn't like the temperature taking of the market, so we're going to withdraw that. But usually, let's say the S1 gets filed, we're ready to go. Then we enter the phase that we call officially the clusterfuck phase, which is we don't know exactly
technical term.
Technical term. What goes on here? There's a lot of horse trading between the investment bank and the founders and the CFO and advisors and lawyers. Many different things can happen during this period. So depending on your company, it could go very smoothly, or it could be a lot of back and forth. So that's why these IPOs kind of can take, the S1 gets filed, the IPO typically doesn't happen until a couple weeks or usually a couple months afterwards. Unfortunately for us and for you, the client or potential client, during this time period, this clusterfuck, is when people seek out advice, because that's when we start to see real numbers and they go, hey, I need some advice on my company. We're going public next week. Luckily, at Brooklyn FI, we're pretty well equipped to help you quickly. You can come to us and say, hey, my company's going public next week. I need some advice right now. We can rush and get that done. Like I said, I'd love to see you 4 or 5 years ahead of time. A year out would also be a great time to get some planning. So we have at least diversity between tax years. If you come to us now and your company goes public in March of 2026, that's a great timeline for us to get you some tax advice where we can actually make a difference in the outcome. So then moving along here, we have the public offering. Your company flips from private to public. You get assigned a ticker, and you are listed on one of the exchanges, probably the NASDAQ or the New York Stock Exchange. Then we don't really have this on here, but basically then there's usually some kind of blackout. There's some sort of period where you are unable to transact any shares in your company, which sucks. That period sucks. We hate that. So we want to see you earlier so we can actually do some planning around that and actually be able to have that exit that we so covet. And then basically after that happens, we want to activate our diversification plan and trade quarterly. Now that your company is public, you are going to be subject to these trading windows as long as you are an employee, and potentially after you leave if you still have some what we call material non-public information. So if you're the CFO of the company or on the finance team, you probably have some information that the public doesn't have. So your ability to trade the stock is going to be restricted. There are ways around that. Come see me after class so we can talk about a 10b5-1 plan if you like.
Ooh.
Next
equity,
slide, please.
400 level equity comp stuff right there.
Next slide. Thank you, John. Prepare yourself for conflicting information from various sources. Yes, indeed.
Hashtag fake news.
Fake news. Yes, exactly. You're going to be getting information from HR. You're going to be getting information from probably where the cap table is housed. A company called Carta might be sending you emails saying you got to do this. There might be last minute changes and unexpected restrictions that you didn't know about. You might get information on Tuesday that says, oh yeah, you're able to sell up to 20% of your holdings on Friday when we IPO. And the day before they might say, whoops, we did the calculation wrong. And actually you have access to this information. So you're on this blacklist, so you can't trade at all. We have seen all of this. So just the best advice we can give you is just be prepared for it to kind of be a shit show. So like I said, the best planning we can do is ahead of time and just kind of wait and see what happens and then trade when we are allowed. Also prepare yourself to deal with something called a transfer agent. One of the most common ones we see is Computershare. This is a firm that really hasn't changed their technology or process since 1986.
Since it was popular to name companies Computershare.
Yes, exactly.
Yes.
So you may get things like a check in the mail for $350,000 that will end up on the vestibule of your apartment on the Lower East Side. True story from a client. So just again, this process, while going public is very exciting and is a very technologically advanced action, and the actual trading happens in microseconds. The actual transfer of shares and the flipping from private to public, unfortunately, is just actually a paperwork nightmare. So it's going to go slow. Be prepared to get on the phone is just the best advice I can give you. You will be opening brokerage accounts at a firm that you might not necessarily want to. Your firm might say, hey, you have to open a brokerage account at Morgan Stanley because we need a place for these shares to land or these proceeds to land once we execute your sale orders. So typically, sometimes folks go, I don't want to be at Morgan Stanley. I prefer Vanguard. They open an account at Vanguard and we transfer the shares. I don't like that, folks. It just creates an extra form and complexity. One of the biggest challenges with equity compensation is tracking your history. When did you receive it? When did you exercise it? When did you sell it? And if we have multiple reports and we have one share moving from Carta to Vanguard or Carta to Morgan Stanley to Vanguard, it just gets really complicated. We can do it. We can look at the spreadsheets, but it's just errors will happen if we have a bunch of different conflicting information. You will likely get frustrated at technology. You will get frustrated at antiquated systems, and you will get frustrated at bad data. One thing to watch out for that I have seen over and over again is when you think you have incentive stock options and on your report that you get from Morgan Stanley or Carta or Fidelity or Schwab, and it says, I've got 200 shares of incentive stock options. And I ask you when you left the company, and you say 3 years ago, and these are unexercised shares. I'm sorry, you don't have incentive stock options. You have non-qualified options. So just be prepared for statements to lie, and that the reality is going to be the statutes, the laws, and the laws will trump anything that your statements say. A statement is just, what the company thinks that they have the data on you. So to keep good records, a company like BKFi can help you keep really good records. We will actually keep really good records for you once you start exercising and selling. So yeah, just be prepared for a clusterfuck. Next slide, please. Yeah, so just get your statements and documents ahead of time. Be prepared to execute a simple strategy for that first trading window. It happens really quickly. On that first day when the company flips, typically you're not actually able to go in there and trade until around lunchtime. Markets open at 9:30, ring the bell. Because it's a newly listed stock, the actual volume moving of shares doesn't typically happen until around noon. That's often a shock for clients that we have to kind of prepare you for. Speaking of being prepared, prepare to pay about 50% in taxes. That's just typically if we have shares that we're selling and that we're exercising and selling within a year. Usually we do that on the same day. Just be prepared to pay 50% mentally, and hopefully we can make that a lot less. But just being prepared for that big tax number is going to help this process be less painful and more of a good thing than a bad thing. And then finally, have cash accessible for exercise windows and tax bills. Sometimes a lot of this process is hurry up and wait. And then you've been waiting, you've been emailing for 3 months saying, hey, I'm ready to do this. Where's my paperwork? You might get an email from a lawyer saying, great, here's the number. I need you to wire $25,000 within 24 hours or you can't exercise shares. So John and I have seen a lot of times where we want to execute a plan, but unfortunately, we just aren't given enough leeway. So we're going to get that really short notice. So if you do have cash available, make sure it's in an easily accessible bank account. Make sure it's at a bank. I'm going to go ahead and make this recommendation. Make sure it's at a bank that you can walk into and get a check from or send a wire easily. Unfortunately, a lot of us keep our cash at these lovely high yield savings accounts at online banks. Unfortunately, a lot of those banks don't have great functionality. Sometimes you're actually limited in how much you can withdraw in a certain period. We've seen that before. So my best advice is have your exercise cash that you might need in a bank account that you can access really easily.
Makes total sense. AJ, you want to be able to access it. And there's like a big tax impact sometimes with IPOs, or maybe not if you're really prudent with planning. What's QSBS?
Yes. So what's going to happen usually is you're going to hold some shares for a while. You're either going to pay short-term capital gains rates, which are ordinary income rates. That's that 50% I was talking about. If you're lucky and you get to hold the shares for a year, you might pay our lower capital gains rates. You might pay, I don't know, between 15 and 25%. That's a little bit nicer than 50%. How would you like to pay 0% capital gains tax on your stock? So
I would love that, AJ.
You would love that. I would love that too. I would love this for everyone. Unfortunately, it's not available to everyone, but I'm going to say these words and these numbers and these rules in the hope that it will encourage you to go look at your shares or ask your company if your stock qualifies for QSBS, aka Qualified Small Business Stock, aka Section 1202, aka the greatest tax benefit in the history of the U.S. tax code, the ability to exclude up to $10 million. Count it, 1, 2, 3, 4, 5, 6, 7, 8, 9, $10 million. So if you exercise your ISOs, for example, let's say you're employee 3, your early days, company just raised $10 million basically to pay your salary for a couple of years. You go ahead and exercise your options. You now own those shares. Your company satisfies one of the qualifications for your company to be that qualified small business is that they have to have less than $50 million of assets at the time. It has to be a domestic C corporation. So it cannot be a foreign company. That trips up a lot of our clients for potential QSBS. There are about 11 other qualifications that the company has to hit. So please look up those rules. Please get a lawyer involved. If you have an inkling that your company may qualify for qualified small business stock, spending a couple hundred or even a couple $1,000s on a lawyer now to save $10 million later is a good idea, in my opinion. So we're going to need cooperation from our employer here to confirm that we have qualified small business stock. Your accountant cannot confirm this for you, just FYI. We need actual confirmation from the company. Sometimes I've seen letters from the company that says, yes, on, January 1st, 2023, we only had $20 million in assets and we met, as far as we know, we met all the other criteria. That's good enough for us, your accountants here at Brooklyn FI, to go ahead and say, yep, we're going to go ahead and qualify for QSBS. The most important thing with QSBS is that you hold your shares for 5 years before you sell them. So there's a 5-year holding period. That's the important metric to hit so we can exclude that gain. This is very real, folks. We do a lot of QSBS work here at Brooklyn FI. So if you our biggest red flag, or not even red flag, it's definitely a green flag, is say like, hey, if you think your company will qualify, please let's get involved. Can we exercise now to start this 5-year holding period? I mean, John, we've seen, I don't know, at this point, we must be up to at least $100 million in actual gains excluded for QSBS.
Yeah, we've helped lots of clients with this in various chunks. Some folks it's $10 million, some folks it's a few $100,000, and it is, arguably the biggest giveaway in the tax code and reward for investors. And so sometimes we're talking to folks, AJ, and it is a week or a month before their Series C or Series D, where they're going to cross $50 million in assets very soon. And so we're just trying to exercise what we can to start the clock, not because they're going to go public next year or the year after that, but because we want to start that 5-year clock for QSBS and get in before they hit 50 million.
Exactly. John, I'm going to hand it over to you to take us through strategies.
Nice. Well, thank you, AJ. So, there's some gotchas and things for us to watch out on how to avoid and what to do. AJ mentioned it. Sometimes your accounts are going to be moving during this, the time leading up to this event, from Carta to Computershare to land at Morgan Stanley or E-Trade or Fidelity or somewhere else, right? You want to make sure that that's right. You want to make sure that all that data is accurate. You don't want to lose a dime of those shares that you exercised, pay tax on, started the clock on years ago, sacrifice perhaps other opportunities to buy. And so save PDF statements, log in monthly, save it. Let's have good detailed records so that there are no surprises. You might get locked out during that transition, run into an issue. So you don't want to be wondering, how many shares do I have? What was the vesting schedule? Get that saved on your own personal files separate from that online portal. Next thing we got to think about is that lockup that AJ mentioned, right? You may think, okay, the company's going to go public in a year. My CEO has mentioned that. That's great because I'm going to sell a bunch of my shares in a year when we go public, and I'm going to use that to buy a house next spring. Spring's a popular time to buy a home for folks. A lot of places going on the market. Well, guess what? Oftentimes you're not able to sell for maybe 3 to 6 months after that IPO. You're very limited in what you can sell. That's called a lockup period. And so you may have them right after one. You might also have one right before an IPO, because when all those shares are moving around, your company isn't going to want you to be transacting in them. It's a record-keeping nightmare. And so it's often at least a few weeks ahead of an IPO, sometimes even a month or two, where they say, listen, time out. You're not able to exercise these shares at this point. We want to make sure that all the record keeping's right. And so that's why you want to do your planning ahead of time. That's why you want to know coming into the year what your strategy is going to be, because you don't want to be sitting there 3 weeks out from the IPO finding out, oh, my cutoff was 5 p.m. today and it's 5:18. Another gotcha. A lot of folks call us up and they want a magic bullet that's going to reduce their tax bill, make it all go away. Now, QSBS is a wonderful tool if we start planning about 5 years.
That's a true magic bullet. A true magic bullet. It requires about 5 to 7 to 10 years of planning in order to execute and pull it off, though. And some folks aren't able to do that or join the company later on, and they are going to have a very big tax bill, maybe 24% of the federal level, maybe another 14, 15% between New York, California, state, local taxes. Sadly, there is no magic bullet that's just going to make your tax bill disappear, aside from your equity being worth a lot less, which we don't want to have happen. And so tax planning ultimately is, how do we optimize all these different pieces of your plan and your strategy to mitigate that tax bill little by little, to optimize what shares we are selling, when we're selling them, how we take a look at your equity mix. But there's typically not a magic bullet that's going to make that tax bill disappear unless you're able to get QSBS, which is a pretty good deal. Another big thing, AJ and I talk to prospective clients all day long. Many of you are on this call listening here today. And I joke that one of the biggest values that we can provide is getting the right numbers on your tax return. AJ, doesn't that sound like a little ridiculous to say, like, hey, we're just going to get the right numbers on your tax return? You might say, well, I think I've always had the right numbers. Duh. Yeah,
duh. Yeah,
it's a form. You're just putting in data.
Yeah, exactly. So oftentimes with an IPO, we run into cost basis reporting issues. And what that means is that in that shuffle from Carta to Computershare to Morgan Stanley or wherever, that data got lost about when you exercised and what the price was. They're not tracking it. And so what shows up on your 1099 is $0 in cost basis. when you may have paid, in this case, maybe you paid $25,000 for this and $250,000 for this. So you don't have a big capital gain. You don't have $312,000. Maybe you have $15,000, $20,000, $30,000. We track this very closely to make sure your taxes are done accurately, because this could result in you paying tax twice on this income. That would be a very expensive mistake.
Yep. And honestly, John, this example here shows zero. Like, that's obvious. Like, you would obviously know something's wrong. Unfortunately, what we see a lot of the time is that the number there is just wrong. So accountants don't catch it. An accountant would probably catch if they saw like, oh, there's zero cost basis here. Any accountant would catch that. However, an accountant who doesn't have a specialty in equity compensation sees a number there and they go, cool. Yep. They don't know. They're not auditing your entire exercise history. We are, because this is what we do. So this, I mean, folks, we see this all of the time. This is not a like outlier. What are they called? Black swan event.
Exactly. This is like, every single day when we're doing taxes, we're seeing cost basis.
And just another, we would love to work with you, but if you're not going to work with us, that's fine too. A lot of companies will issue 1099s around now. I actually just got mine from Schwab today, which is pretty late in tax season already. And unfortunately, when we have equity compensation, we actually usually see a corrected 1099 come out later, like halfway through March. So watch out for that. So if you're working with an accountant and you're like, I just have RSUs, I'm good, everything's easy. Watch out for that corrected 1099 that's going to come later that might actually have different cost basis.
And one of the things we do, we have a standing policy here where even if your tax return is done right now, here at the end of February, we wait until about the middle of March to start actually filing those returns, because so often something comes in late, something gets amended, and we want to spare you the headache of filing an amended tax return, penalties, interest, other issues. And so that's something we pay really close attention to. We've learned a lot of lessons from public offerings over time. Some things to just keep in mind. You may not know your restrictions and when you could trade just up until days before the IPO, and it's going to be very foggy. That cluster that AJ talked about in one of our earlier slides. The stock price on the first day may not start moving until lunchtime on the East Coast. When your company goes public, they're going to go through something called price discovery. And so there will be some traders at big banks that are starting to move some quantities of shares, and there will be a target price for the IPO. But ultimately, the price of any stock is whatever somebody's willing to pay for it. And so that's going to take a little bit of time until we get volume and trading to see what that number is. And remember, past performance does not indicate future results. Appliance guy over here. But the first day can often be one of the best days price-wise in the short term. People read about it on Reddit. They get excited. There's all this kind of euphoria. The price shoots up, and then people are able to start selling and start unwinding. And maybe that doesn't stick around for the long run.
Yeah, John, one thing I think we should mention is that that did not exist in 2020 and 2021 when we saw all these IPOs. Now there are all these platforms where you can actually trade or be involved in IPO offerings as a retail investor, meaning you don't even have to be an employee to participate in an IPO.
Yeah.
The problem with these platforms is that it's all about supply and demand. So yes, if a bunch of people on Reddit say this is a great stock, we saw this happen with Coinbase, unfortunately, is that the private markets were saying this stock is worth $650 a share. And a lot of employees got anchored to, oh, my share of Coinbase is worth $650. And then when trading opened, it was actually closer to 300. That's what the public markets told us. So unfortunately, a lot of folks didn't sell their shares, and we actually haven't really seen that stock recover since then. So be aware of kind of like private markets and a lot of the hype around the IPO. We do want you to sell around IPO. We definitely want that to happen. But just kind of be aware of these like fake prices. It's just unless you can actually sell, it's fake news.
Yeah, and I think that answers one of the questions we had, which is one of the hidden risks and downside of going public that people overlook. It's that your price is constantly changing. Unlike when you're a private company, and every few months, your price ends up getting changed because the company valuation gets updated. So, great point there.
I would say another downside is just your ability. I mean, I guess if you're private, you're still locked up and you're limited. But when your company is public and you are an employee, especially if you're high up, you will likely be unable to trade when you want to trade. Just be prepared for that. We can talk a little about 10b5-1 plans later too.
Yeah. And then finally, sometimes you don't go public through an IPO. You go through public through what's called a SPAC, or a special purpose acquisition company, which is a merger. You're merging into this public company in order to go public. And when that happens, it takes some time for the shares to convert. The quantity of shares that you have are going to switch over. there's a lot of fake news, a lot of misinformation, and there's a big hurry up and wait. Sometimes there's a lockup on SPACs. Some have done quite poorly. There were several companies that went public via SPAC in 2021. 23andMe is one that comes to mind. BarkBox is one that comes to mind that we help clients through. Companies that struggled post going public because of the SPAC. Because what a SPAC does often allows companies that are not necessarily ready to be public go public a little bit sooner. We've seen the SPAC mania cool off a little bit though, so just keep an eye on that.
Although I did read an article that said SPACs are back, so we'll see.
Are they? Maybe.
Data does not tell us that they are, but we'll see.
Got it. So AJ, back to you here to talk about what we need to know ahead of day one.
Okay, so ahead of day one, the most important thing you need to know is what are the restrictions, and what is my lockup going to be? Someone had asked, what's a typical timeline for preparing and launching an IPO, and how do you ensure that you meet key deadlines? As an employee, there's nothing typical. Unfortunately, there's no typical timeline. Typically, once the S1 is filed, we can reasonably expect that the IPO will happen, if it's going to happen, in, I don't know, 2 weeks to 2 months. But unfortunately, folks, because of the volatility, we've just seen a lot of IPOs withdrawn or S1s just kind of hanging out there. So I don't have a specific timeline for you. Your company will communicate to you what shares you are allowed to trade. If they don't, for whatever reason, it is your responsibility to find out what your restrictions are. Typically, we see something like, in the first couple days of you'll have an opportunity at IPO for 1 or 2 days, sometimes a week, for the ability to sell some of your shares. Sometimes you're completely unrestricted. You can sell whatever you want. You can sell everything you have. Other times we've seen restrictions like, maybe it's not a large IPO. So the investment bankers say, okay, we don't want everyone to be able to sell everything all at once. That'll drive down the stock price. So there's going to be a restriction. Let's say you can sell 20% of your holdings. You got 2 days to do it, and then you're locked up for a full 6 months until you get switched over to these kind of quarterly trading windows. Super important to have a plan in place ahead of time. It is very emotional to have your stock price, which I would imagine might make up a large percentage of your net worth, tied to public markets. So if you were worth $500,000 yesterday, your company went public, all of a sudden you're worth $2 million. Well, hey, your entire livelihood and your ability to retire, buy a home for mom, send your kids to college, whatever it is you want to spend that $1.5 million on, that is now tied to the performance of your company in the public markets. That is a very stressful and emotional thing to take on if you've never done it before. So we at Brooklyn FI are extremely entrenched in this idea of creating trading plans. And that means let's have a discussion about what your goals are. Let's do a tax projection. Let's see what's going to happen. We obviously can't predict the stock price. If we did, we wouldn't be sitting here. We knew the stock price exactly how it's
be on an island somewhere, perhaps.
But it's important to know, hey, what are we comfortable selling day one? Look, we want to diversify. That's smart investing. But hey, I believe in the future of this company. Long term, I would like to hold 10% of what I have today, 10 years from now. Great. Let's work back from that. We've got 90% of our shares that we have to exit. Let's do it over a 2 or 3 year period, because that's just smart tax planning. So having a trading plan in place ahead of day one before that price starts moving is really important. What are the logistics? Do I need to wire cash somewhere? Where do my proceeds go? This is just important information to have. If you've never sent a wire before, get used to it. Just pay the $25 fee and move on with your life. Trust me, it's a lot easier than setting up an ACH. Just swallow that $25 and move on. Your proceeds, you want to know where they're going to end up. They'll probably end up in a brokerage account, probably somewhere like Morgan Stanley or Schwab. Unfortunately, John and I have seen folks who had an exit 2 years ago, and the proceeds from that IPO sale are still sitting in cash in that Schwab account. So make sure that you have a plan for where these proceeds are going to go. Hopefully, they're going back into the market, into a diversified portfolio, not just owning that one single stock. Another thing to watch out for, if you spend any time working abroad, be prepared for a lot of withholding, especially if you're selling RSUs. So a lot of folks ahead of an IPO will have only RSUs, and those RSUs might be double trigger, meaning that when that IPO happens, all of a sudden, all this income happens. So the RSUs get sold, and then all of a sudden you have this massive tax bill. If you spend any time abroad, what's going to happen is the company will actually withhold more than you probably owe. So that can just be confusing. Have an accountant look at those statements before you get your return filed. And then finally, have a plan for what to do with that lump sum of cash. What's your tax bill going to be? That's why you have a partner like BrooklynFi to do a tax projection and say, here's what your tax bill is going to be. Let's hold that in cash or even make a tax payment if the number's really big so we don't run penalties, and let's invest the rest, right? We want to move not so quickly that we trip over ourselves, but we don't want to have that, if we took money out of a high growth stock, we want to make sure we put it back in the market and not have it sit in cash. What else we got here?
So often we've had that happen, AJ. And the international withholding is always fascinating. I remember one time we went through an IPO and they didn't have the international withholding set up yet. So it defaulted to Antarctica as the withholding destination. That was real funny. I was like, wait a minute. When did you work in Antarctica? And wait a minute, they don't have taxes there.
All right, liquidity event tips. So we're talking about IPOs today, but there are, of course, other types of liquidity events. The most common type of liquidity event is a merger or acquisition, right? It's not a public fanfare. There's no bell ringing with the bull on Wall Street. It's just, hey, our company was acquired. You now own stock of this other company, and or we liquidated all your shares. So that's just be prepared for that as an also potentially good outcome. So some considerations, if you have stock options, aka ISOs or NQOs, not RSUs, you do have more planning opportunities pre-IPO. If you have ISOs or non-quals, please get a financial advisor or at least a CPA who can do a tax projection for you. There are opportunities here to change your tax outcome. With RSUs, unfortunately, there's not a ton we can do to change your tax outcome ahead of the IPO. After the IPO, absolutely, we can help. Setting up a budget for exercising. If you do have ISOs, there's going to be some pretty intense tax planning that we're going to be doing. So just knowing, hey, how much am I willing to risk of the rest of my net worth on this one company? So thinking, we just like to call it a budget, like, hey, I've got 10K to risk on this. How much that's going to influence how much we can exercise. Like we talked about earlier, if we have that QSBS opportunity, we might need to pull out more cash to make this investment in this company. If we are exercising ISOs, we got to think about AMT. That's another webinar for another time. But just know that while incentive stock options can have a favorable tax treatment, you might unfortunately trip up the alternative minimum tax rules. My business partner and I, Shane, just did a podcast for a podcast called The Liquidity Event, where we did a deep dive into ISO. So if you have those, go ahead and check that out. NQOs don't get that special incentive treatment. So if you do exercise non-quals, you are likely going to get a big ordinary income tax bill. And if we don't do tax planning, that could be an unfortunate surprise with penalties. And finally, double trigger RSUs, which I touched on a little bit. If you have both RSUs and incentive stock options, that is like candy to me. I see so many planning opportunities there when we have these two different types of equity compensation. If we've got some RSUs that are vesting, that's going to bring our income up a lot higher, which is going to give us a larger budget to do some ISO exercising and holding. So just some tips for you when you have been at a company for a long time and you're thinking about an IPO. And folks, I'm sure a lot of you are wondering like, well, what's the timeline? How do I know when we're going to IPO? And that's what we're trying to say is like, we don't know. And in our experience, a lot of folks have been at these companies for 5, 6, 7 years waiting for this IPO. It's not happening. And unfortunately, what we see happen is that folks end up having to leave their companies because better opportunities come up and they just can't wait around for an IPO anymore. So another important moment to do some planning is when you're leaving your company, because sometimes those options are going to have an expiration date. So you kind of like got to use them or lose them situation. So just be aware of that if you're leaving your company, or exercise them or lose them, whatever. You know what I mean?
Same thing, right?
Same thing.
AJ, some folks though, maybe, companies when they're getting ready for an IPO, approaching that, they've raised money, they're getting bigger, they may be getting profitable, and therefore they're hiring more people and they want to give them equity. And so their considerations are typically a little bit different. Their equity mix is also a little bit different as well, right?
Yeah. So yeah, if you're a newer employee, meaning, you're your company is gearing up to go public, you may have something called double trigger RSUs, which basically mean you start vesting those RSUs. So you're putting in your time at the company, you're getting compensated with this equity compensation, hence the word compensation. So you receive the RSUs, but because there's no public market and because employees and the IRS got together and said like, hey, this isn't fair. I'm vesting these shares, I'm paying tax on them, but there isn't a public market. There was this clause inserted called double trigger, which basically means an event has to happen where there is a public market for you to be able to sell some of these RSUs to cover the tax bill. Because when these RSUs vest, taxes due immediately. And that's important to recognize. But when you have this double trigger, you actually get to wait until that liquidity event, that IPO, to pay the tax and receive the shares. So it's a nice benefit because you're not paying tax on private shares that have no public market. The problem that we've seen, well, income's never a problem, in my opinion, but it can create this very large tax bill or a very large income year. So that's an opportunity for us to do some tax planning when we just know, hey, you might have a $2 million W-2 this year. That's an opportunity for us to get in there and tinker around. Just one thing to watch out for with holding on RSUs, when you are at a public company or we've hit that second trigger, there is automatic withholding. So the IRS is not going to leave it up to you to pay the taxes. They're just going to take the taxes out as those shares vest. And typically those are withheld at 22% at the federal level, up to $1 million. Unfortunately, what we see with some of our higher earning clients or our clients who are married to equal or higher earners is that their federal tax rate is actually higher than 22%. It's actually probably closer to 35%. So we have that delta. So unfortunately, we get hit with a big surprise tax bill because we just weren't withholding enough. So if you are able to talk to your company about increasing your withholding, that would be a good idea, or we can help you do a tax projection. So at least we're prepared for that number and we can either make a prepayment or just know that we have that money in cash because we know we're going to owe it anyway.
Absolutely. Absolutely. Not a lot of folks in the 22% tax bracket that are having $1 million equity events, right? And that's where that disparity can come into play. And
Indeed.
then AJ, we've seen in recent years a lot of activity that's not IPO related, but allowing folks to get liquidity, tender offers, and secondary sales being two of the most popular of those.
Yeah, everyone's just a fraidy cat and isn't going public, but folks need liquidity, and companies need to raise, right? A lot of these companies haven't raised since 2018, 2019, and like, oh shit, we need another $100 million to keep the lights on. We got to go out to investors and figure out, how to get more capital. So typically the way we do that is through a tender offer, which basically says, hey, we have employees who want some liquidity. We have new investors. Hey, employees, if you want to sell 20% of your holdings, you can do so today. Here's the fair market value price. And you can have a little bit of an exit. So we at BrooklynFi love tender offers. We think it's a great opportunity. Another word for this is secondary sales. They're slightly different. But it's a great opportunity to get liquidity sooner. Some folks will come back and say, well, today the shares are worth $10, but this is so early days. Like these shares are going to be worth $60 in 5 years. Yes, I absolutely hope that's the case. Just in case it's not, let's exit 15, 20% right now at $10 a share just to grab some liquidity and take some risk off the table. That's just smart. It's just smart planning. Folks most of the time regret not participating in tender offers. And yes, if those shares are worth $60 a share in 5 years, you're going to have a fantastic exit anyway. You're not going to care about the 15% that you missed out beforehand. And you had to wait 5 years. So you probably use that cash for something awesome in the meantime.
AJ, I think we had clients a few years ago who were selling on the secondary market at $60, $70 a share for their company. The company still hasn't gone public, and now they've been selling for $15 or $12 a share. And so those folks who took chips off the table a few years ago in that secondary, who thought they were getting up a little bit upside, were actually really mitigating their downside.
John, I hate being right. I really do. I really hate it. And look, many companies will restrict your ability to do secondary sales. Tender offers typically start from the company. It's a very specific period. Usually it's less than 30 days. And they say, hey, here's how much you can sell. This is the transaction. Here's the platform. We're going to handle this. A secondary sale is typically outside of the company. And you got to check if you can even do it. Most companies do not want random people on their cap table. They don't want random owners. So you can't just go on the street and say like, hey, you want to buy 50 shares of Stripe? I'm selling. Like, Typically, that's not allowed. Sometimes you can find a qualified investor and do a secondary sale. There are some platforms such as Equity B or Equity Zen or
Forge, a few
Forge.
others.
There's some the names that will potentially buy your shares and will potentially be blessed by your company. Forward contracts are a way to get liquidity now, so you can get your shares later. These can be good options for you if you need to leave your company for whatever reason, but you're still excited about them and you want to wait for the IPO. So that's another way to kind of take a little bit of a risk off the table, transfer the risks to someone else, but still be able to exercise your shares. A good example of that is, hey, I've been at X small company for 5 years. I'm being paid $130,000 a year and a lot of equity. I got this amazing job offer at Google. It's going to pay me $500,000 a year. I'm going to run my own team, my own AI team. I'm really excited about this. I cannot turn down this opportunity. What do I do? I need $200,000 to exercise my shares. You can go to one of these companies and work out a forward contract agreement where they'll basically front you the cash. You'll have to pay them back and they're going to get some of your upside. But in the event that you have an upside, you get to keep 80% or 70% of your exit rather than nothing. So I'd rather keep 70% of a $10 million exit than 0% of that exit if it was up to me.
Yeah, and these forward contracts, the one thing to point out for folks is that they are a little bit more complicated tax-wise. You want to have a CPA that understands them and how to report them, because there are different rules as to whether they're an open transaction or not. The TLDR here is, I'm sure your uncle, the CPA in Toledo, is a wonderful guy and will do this return for $300. He just probably won't do it right if he doesn't see this stuff all the time. And so some things for us to keep in mind when we think about it: tender offer, secondary sales, that sort of thing.
Oats.
Awesome. Well, wrapping up here, folks, before we jump into Q&A, a couple of things. We've got tons of resources on our website, tools that you can tap into as you're approaching these sort of events. And, you may be having not an IPO, but you might get an email next week. Hey, we raised our next round. There's a tender offer. You get to decide in the next 2 weeks what you want to sell. We can move quick to help you with that. We've got some tools on our website. We have an equity education series. We have a podcast called The Liquidity Event. And if you're saying, hey, my company's getting close to this, I do need to do some planning here, I want to just understand if BKFi is a better fit for me, hop on our website, brokenfi.com/discovery. There's a link just about everywhere on our site to book a call with us. You'll get to meet with AJ or myself, chat a little bit about your needs, and we'll see if we can help you. We'll help you out now, help you out later, see if we're a fit, because we deal with this stuff day in and day out. And so we have a handful of questions here, and then we'll get to our gift card giveaway. And so we'll bounce back and forth, AJ, between some questions that we had in the chat live and some that were given to us ahead of the call. This question I liked a lot, which was, can donating shares to donor advised fund help reduce taxes during an IPO? Is it advantageous to sell your newly listed stock rather than selling it, to donate your listed stock instead of selling it and donating the cash? AJ, you want to take a stab at that one?
Sure. I like donating appreciated stock. I think the tax treatment is actually more advantageous to you personally. Unfortunately, it's not as advantageous to the charity because often they have to wait longer to get the money. Charitable planning and charitable gifting with equity compensation is a complex relationship. Typically, we talk about charitable gifting at the end of our lives or once we know we are 100% confirmed in our financial independence. So unfortunately, when folks are going through their first or second liquidity event, yes, charitable gifting is a fit through donating your appreciated stock to a charity or to a donor advised fund is in my opinion, the best way to get the tax benefit of donating to charity. However, we don't want to let the tax tail wag the dog, because what if you need that money? I'd rather have you keep some of that money this year, pay the tax on it because you might need it. If it's $1 million and you donate half of that, remember, donating to charity is still the money leaving your accounts. Yeah. So we want to think about our charitable gifting plan for our lifetime before we start making tax plans, if that makes sense. I'm very pro charity. Sometimes I feel like I sound like I'm like, don't give to charity, but we need to make sure that you're taken care of first before we start giving it away. A lot of the estate tax strategies you might see on TikTok that talk about all these complicated trusts, a lot of those trusts are not suitable for people who have 50, 60 years left of life to live. A lot of the estate planning is designed for people who know that they're not going to need the money. They've got 10 years left to live. You're 85 years old. You got $10 million. hell yeah, let's start giving it away. But if you're 35, 45, 55, there's a lot of unknowns. We might need that money. So I'm always hesitant to talk about donor advised funds and charitable gifting from a tax standpoint. Once we have the need in our financial plan, sure, our tax team can tell you the best way to give away money.
Absolutely. The one thing I want to add to that is when we think about gifting shares, especially if you have ISOs and you exercise and you paid AMT on the exercise, you often don't want to gift those shares because it's going to be harder to get your alternative minimum tax credit back.
Great point. Great point, John. Yep. And that's another reason why we would love to see you as early as possible, especially when you have this complicated equity mix, because there's just so much planning opportunity, so many planning opportunities we have if we catch you 3, 4, or 5 years ahead of the IPO.
Absolutely.
What else you got for me? Does your advice? Oh, go ahead.
Oh, go ahead. No, go ahead.
Say more about moving states before, during, or after an IPO for tax reasons. Oh, I love this question, but John, I'll let you take it.
Okay. Geo arbitrage comes up a lot, right? A lot of folks live in New York, California. They have equity compensation. They were granted a few years ago. They vested it. They worked at this company in the Bay Area. Maybe they even left the company now or are thinking about it, or they want to go work remote hybrid in Florida. And they think that is the unlock because Florida does not have an income tax, or Texas, take your pick. Well, it's a little bit more complicated than that. And states like like New York and California have clawbacks that say if you worked here and were granted and vested this equity while you were living here, we want a piece of that action regardless of where you're living when you're exercising it or when it's the double triggers being hit for those RSUs. And so we have some folks who've lived in Florida, lived in Texas for the last few years. Their company's going public now, and they're paying tax in 2 or 3 states that they don't live in anymore because it's clawed back there. Now, there are some strategies, especially when we're talking about long-term capital gain property. So shares that maybe were previously exercised, vested in another state, pay tax on that exercise, and now have appreciation. When there's more ability to arbitrage when we're talking about the capital gain and where you're living when you recognize that gain that there is with options and equity. And so it is not a silver bullet. You need to talk to tax professionals who deal with this all the time before you make those decisions. Because the last thing you want to do is uproot your entire life, move somewhere else because you think it's going to save you money in taxes, and ultimately find out it's not saving you nearly as much as you want. So you're away from your friends, your family, your loved ones, all that fun stuff.
Yep. Great answer. I'm going to grab one from the chat. How difficult is it to set up automatic sales of your equity shares post IPO? Do lockup periods make this impossible? And do future or ongoing equity grants vesting post IPO impact cost basis when selling shares? Ooh, I love this question. So it is difficult to set up automatic sales of your equity shares post IPO. The only way to do this is through what's called a 10b5-1 plan. And typically these plans are, well, first of all, they're mandatory for CEOs and CFOs and are often optional and or encouraged for any of the C-suite or anyone at the company who has this material non-public information, meaning you know something about the company that the public doesn't know that may impact the stock price. This is what we're talking about here is insider trading. A couple of years ago, there was a news story. Remember COVID when that thing happened when we all sat inside for 3 years? And there was a vaccine that was going to come out, and a certain executive at Pfizer knew that the vaccine was going to come out. They had a huge breakthrough. This person did a share sale. I think it was a 10b5-1 plan. I think they put this list of trades in, and then the news came out just a few weeks later that the vaccine that they had cracked the code and obviously sent the stock price soaring. Right at the moment that he had said, here's how many shares I'd like to sell. So that's what we're trying to avoid. We're trying to avoid insider trading. Insider trading is very real. You will get arrested if you engage in it. You will likely be tried and sentenced. The American public loves to see people go down for insider trading. Please see Exhibit A, Martha Stewart. She's she's our best scapegoat for that. So to set up one of these plans, John, I have seen these become more common. I have seen a lot more companies offering 10b5-1 plans. So setting one up is actually not that difficult. It's just a question of whether your company offers it or not. Now,
because they often do not offer it to the masses. It's not, if you are a rank and file software engineer, they might not set it up because there is a cost to them to doing it. You might need to be executive level, have certain inside information. But if you're normally able to just trade each quarter in the window because you don't have that info, you're probably not you might not necessarily be eligible for one.
Yeah, and honestly, a lot of companies want to manage risk, so sometimes they'll just kind of say, "Sorry, you're locked up this quarter because," and we've seen this happen with like marketing teams. Like, "Hey, marketing, like about this big new initiative, so like the entire marketing team literally cannot sell this quarter." So unfortunately, it is difficult. We love 10b5-1 plans so much at BrooklynFi that we actually create them. We kind of create mock 10b5-1 plans for our clients. So even though your company won't let you do one officially, what we can actually get.
Oh, we lost your audio there for a second, HA.
Yep. Am I back?
You're back.
Great. Okay. What we can do at BrooklynFi is actually take over your account, get access to it. You're going to give us permission, of course. You're going to sign off on the trades we're going to make, but we can actually go in there for you and kind of automatically sell your shares at the predetermined number of shares to sell and the price that you want. So that's kind of cool. We love offering that feature because a lot of clients, they'll go in to sell their shares and they're like, "Ooh, I don't like this price. I thought it was going to be $13 a share and it's 11." It takes a lot of the emotion out of it. And we sell your shares on Tuesday, and by Friday, your proceeds are invested back in the stock market in a diversified portfolio. So yeah, love that question. Thank you, that person who asked that.
Yeah, and I think there was a second part of that, which is like, how do ongoing vest and grants post-IPO impact cost basis when selling shares? Main time cost basis gets impact when selling shares with future vest is if you're selling at a loss and you're vesting every month. We have to worry about something called a wash sale issue, which is that loss gets disallowed. So we see this a lot. Companies like Google, for example, do monthly vesting of their equity, and they allow just about anybody to set up a 10b5-1 plan, which is a pretty nice deal. But if there are losses between when the share vests and when they sell, they largely get disallowed. So it does make a little bit of a cost basis nightmare. I think those are a lot of the questions we had here.
Yeah, I know
AJ.
folks asked some questions about the company side of things in IPOs, but that's really not our expertise here at BrooklynFi. We really focus on helping the employees. So I have never taken a company public, but I have helped lots of employees on their side go through the exercise and have these fantastic exits. So if you have questions about how to run company IPOs, you got to go to the investment banks or a law firm.
Thanks to everybody who came out here today. Like I said, we've got a ton of resources on this. And so just to reiterate them, head to our website, brooklynfi.com/equity education. We will have the recording of this webinar. If you just step out for a second, the stove caught on fire, kids were yelling, whatever it might be, and you need to watch this recording, we'll get it up on our blog here in the next couple of days, so you have access to that. We'll send it to you as well. Thank you for joining us. And if you have questions, feel free to reach out. Feel free to book a discovery call with AJ or myself. And thanks again for tagging along here today. Thanks, AJ. It's been a blast.
Thanks, John. Thanks, everyone, for attending. Hope this was helpful. See you next time.